Hello, welcome to the Shipper Update. I'm lead economist here at FreightWaves, Anthony Smith, and I'm here again with the one and only Donnie Gilbert. And Donnie, the thing that moves the economy, of course, is the consumer. I mean, when we look at GDP, a large portion of it, the majority of it, is going to be built around the consumer. When you're looking at roughly, I think it's 67 right now, maybe nearing 68% of the U.S. GDP is going to come down to what's going on with the consumer. And so when you're looking at what's going down with personal consumption expenditures, that's going to be impactful for overall freight, especially when you look at what we have here in this orange line, and that's, in the blue line, and that's going to be personal consumption of durable goods. So that specifically is going to lead into more freight volumes throughout the country when you see more consumers buying consumer or durable goods. Of course, durable goods being things that have a shelf life of 3 years or more. And looking at that, Donnie, it's easing. I mean, it still grew 1.1% in the most recent month, but there's a slight easing in effect right now. And of course, we're looking at that slight downward movement, but still growth nonetheless. We can see some of those trends mimicked or really kind of preceded in that orange line here, of course, in our van outbound tender rejection index or tender volume index.
Well, we talked about kind of right here before. We can't stay at the peak forever. We saw this peak up. We've seen it kind of come down now. Right here. Now, of course, again, we've got the back to school. We're going back to school. We're kind of slowing down here. So do you expect that to kind of maybe slow down for just a little while and then take back off as we enter the fourth quarter for the retail Christmas season?
Exactly. And so I think when we look at it, we have to look at the health of the U.S. consumer. And so what we're seeing right now, the consumer is pretty relatively healthy right now. We're seeing that even though those employment benefits are starting to taper off, states have really eliminated it on a one-by-one basis when we look throughout the country ahead of the federal mandate ending. And we're looking at what's going on with jobless claims. They're starting to come down, they're moderating, they're easing in a sense, but they aren't spiking. So that's a good sign. We're seeing unemployment rates come down slowly but surely. So looking across the board, we're seeing that consumers are in good position. Quit rate is still high, so consumers are feeling confident about getting back into those places. Where we're seeing some constraints, of course, is on those shipper side, those producers, where they're needing more people to get back into the workplace to produce these goods.
So we're measuring this in billions of dollars, right?
Yes.
Now, there's been a lot of talk about inflation. So if this is coming down, yet rates are still kind of inflated anywhere from 3-4% at the retail level, 7-9% in the grocery stores. We've obviously seen a lot of inflation, the highest inflation since the 80s. If this is coming down, could this actually be a lot steeper if we took inflation out, or is inflation in here? Talk about a little bit of inflation and how that is going forward with this.
Definitely. And so I think that's going to be an excellent segue into one of our next charts and what's happening upstream, because it all happens upstream. Of course, we see those manufacturers, those producers upstream, they're going to take on a big brunt of this inflationary pressures. And so we're looking at what's happening right now. We have our blue line is going to be the ISM PMI. Of course, it's going to be that diffusion index that we were talking about earlier on with the flatbed. But if we go one more chart ahead of this, we're looking at prices. And that price component is showing what some of those inflationary pressures are coming from upstream. Those manufacturers right now are seeing historic levels of pricing pressures. Now, they're having issues sourcing those commodities. Those commodity sources are going to be in shortage, and so that's going to put upward pricing pressure. Their bottlenecks right now constraining production. That's going to put upward pricing pressure. And what we're going to kind of look at is, in a sense, shrinkflation. And so you're going to be paying the same price for less stuff, in a sense. And so that's already starting to impact a lot of industries right now. But really, Donnie, just as you said, that inflationary price pressure is still at play, and it's starting to moderate in a sense. It's slowing, but it's still very much active. And when we're looking at these inflationary pressures, it's going to be here for some time, especially if we're seeing that this demand continues to stay at this high level. Although we're not at this hyperdrive speed that we saw throughout 2020, 2021, starting to ease in a sense. I think that easing is going to moderate and ease into 2022. But I don't think that easing is a sense of recession or contractionary trend. We're still going to see a lot of demand still in the year to come.
Unemployment. Is it still an issue? I mean, you still see a lot of people complaining, mainly the food restaurant industry you see. I went to go get some food to go yesterday, and they were already closed at 2:30 because they didn't have any people there to work. But is this still playing in the industry? And I guess maybe this kind of slows down a little bit, will kind of play better into the employment level that they currently have?
Definitely, it's going to be a huge factor. And just as you mentioned on the service side, an incredible factor. You mentioned an anecdotal story right now where you saw that there's a limited amount of hours and things like that. So that's going to be an issue not just in those services downstream, but upstream as well. In our next chart, we're going to look at what's going to be interesting, and that's going to be new orders and backlogs in our next chart, and we're going to see that, of course, put out by the ISM as well. And so within the ISM, they put out this backlogs of orders number, and that shows that there's still a lot of back orders to kind of work through. And those backlog of orders are going to be essentially telling us that there's still a lot more production, even if we're at production capacity or near production capacity, that we can't quite meet those demand levels. And so because of that, it's going to be either going to come down to capacity issues or capacity issues, of course, with the manufacturing capabilities, but also with the amount of employment that's on board or on staff right now. And so that's exactly going to be one of those things, the limiting factors upstream for sure. We're looking at what's going on with the manufacturing.
That makes a lot of sense. I love to camp.
Yeah.
I saw a camper manufacturer, which is a very large camper manufacturer, that is $14 billion in pre-orders they still have to fulfill, and their factories are at full speed.
Yeah.
So,
and even as this starts to ease and slow down overall, there's still going to be a lot of momentum because of scenarios like that going into the remainder of, or going into 2022.